Hi all, Happy New Year and welcome to my first video of 2026. As mentioned in my previous video, I will be revealing which are the 6 stocks in my portfolio that I think will come out top in 2026. If forecasting my portfolio's return is elusive, to predict which stock will be winner in the short term is practically mission impossible. There are just too many factors that could affect the stock prices, such as business uncertainties, macroeconomic noise, and ever-shifting market expectations. That said, it still feels like a fun exercise to document my own thoughts and revisit my long-term thesis. To make it very clear, these are absolutely not recommendations, and I won't be surprised that some of these could easily turn out to be my worst performers for this year. First up is ComfortDelgro. The recent results are encouraging, with strong growth in both revenue and profits. It has benefited from its overseas expansion last year, and with Stockholm Metro going live last November and Jurong Region Line starting in 2027, the growth should continue. Its dividend policy of paying out at least 70% of its annual profit also meant we can expect an increase in final dividends. Closing at $1.48 last year, it's trading at a trailing PE of around 14.5 times and a dividend yield of 5.5%. That's quite decent, and if current trends continue, the forward PE could drop below 14x, offering an attractive forward yield of around 6%. Now, what could go wrong? The overseas expansion which brought it success could become headwinds. With higher debt, finance costs increase. Operational uncertainties such as potential labor shortages and strikes or currency fluctuations could also impact the underlying profits. Not forgetting competition is also heating up in Singapore too. Besides facing Grab in the taxi business, it also lost the Tampines bus package this year. I'm wary of all these challenges, and having just reinvested in CDG, I will keep my position small. Next is iFAST Corporation, which has been firing on all cylinders last year. That momentum should carry on with the ongoing Hong Kong EMPF onboarding and increased deposits in iFAST Global Bank. Growth prospects remain bright with its ever-increasing new licenses and services. Moreover, ORSO, the other HK pension service, is expected to contribute from the second half of 2026. However, is a PE of 33 times too expensive? I don't think so. If iFAST can sustain a growth of above 20%, it will bring the forward PE to mid-20s. And if that growth can continue for years, then the current price would be a bargain. The downside is basically execution risks. If teething problems with the e-pension system persist or the synergies from the bank take longer to materialize, it will impact the bottom line, reducing its growth. A broader market downturn could also impact investor sentiment and affect its core wealth management business. Having followed the company and management for more than 8 years, my conviction is much higher than CDG, which explains my near to 10% position size. Moving on to Parkway Life, the star defender in my portfolio, the key catalyst for this year is the completion of Project Renaissance. Due to the increased rental, DPU is expected to jump above 18 cents. Besides that, it will be a full year of contributions from their France portfolio, and we can also look forward to the Gleneagles asset enhancement initiatives. However, at $4.08, the trailing yield is just 3.7%. Is the yield too low? Well, with the projected DPU, it will be around 4.4%. Historically, P-Life traded at a premium at around a 4% yield, so it's quite a good deal now. So what could go wrong? The pro forma figure was provided many years ago. Since then, interest rates and operating expenses have increased. Also, while I like its hedging strategy, it's not totally immune to huge currency fluctuations. Hence, there's always a possibility that DPU might not go above 18 cents. Finally, while it's not an immediate issue, I'm keeping a look out of the secondary impact on its Singapore hospitals due to the changing insurance landscape. Next up is UMS Integration, which like CDG was another reinvestment. I saw the catalysts in late 2024, which unfolded last year. The ramping up was work in progress, and we might finally see some meaningful numbers this year as it speeds up shipments to the new key customer, not forgetting the upcoming 1-for-4 bonus issue. Here's a fun fact. 4 out of my top 6 picks are actually constituents of the iEdge Singapore Next 50 Index. It's purely coincidental. I realized it only when working on this video. A PE of approximately 24x and a dividend yield of 3.5% isn't really attractive. However, if the ramping up comes true and this is the start of an upcycle, the numbers would change. Moreover, after the bonus issue, you will be receiving 25% more dividends, provided UMS kept to its past practices of maintaining the same dividend per share even after the bonus issue. The semiconductor industry is notoriously cyclical, and the cycle is hard to predict. Ramping up production might take longer than anticipated, impacting their growth trajectory. Speaking of the semiconductor industry, another stock in my mind that might turn out to be the dark horse this year is AEM. While I feel a lot more confident about UMS, AEM could potentially surprise on the upside if the ramp up for its new fabless customer truly materializes. It might also benefit if Intel recovers, and provided that there are no further hiccups in its execution. So, for those of you following the semiconductor space, are you in camp UMS or camp AEM? I'd love to hear your thoughts on which company you believe has the stronger outlook for the coming year. Drop your comments below, and I would also appreciate it if you could just take a few seconds to click on the like button and subscribe to the channel. Now to the US market. Alphabet was my top gainer last year, and with the current momentum, I wouldn't be surprised if it ends up among the top again this year. The cloud segment's 35% growth last year proves that it's no longer just an ad company. Cloud is now a primary growth engine. Gemini's integration is hitting its stride, but the real secret sauce is their tensor processing units, TPUs. By using their own chips, they aren't just saving on costs. They're beginning to rent this silicon to third parties like Anthropic and Meta, turning a massive internal cost into a high-margin revenue stream. After gaining more than 60% last year, is it too late to join the party? Just like iFAST, I think it's reasonably priced for its immense growth potential across various segments. The focus should not be what happened last year, but if the current price is worth its future growth. One significant risk is accelerating capital expenditures. While necessary for growth, these investments could compress profit margins further in the short to medium term. Regulatory scrutiny and competition in AI are also ongoing considerations. I'm glad that my small position last year has grown bigger and put Alphabet among my top 10 stocks. Going forward, I will just let it grow organically. Finally, let's look at the trade desk, which was my biggest loser last year. You can see that it is still growing well, with 9-month sales and profits up by more than 20%. The plunge last year was due to its elevated valuation, as the market was expecting even more. I'm expecting similar above 20% growth this year from them, and I think the new hires from tech giants like Google and Salesforce could accelerate its market penetration in the open internet space. So after plunging by nearly 70% last year, is it a screaming buy now? That really depends on your conviction in its growth story. If Trade Desk can re-accelerate growth with the new team and strategic initiatives, this valuation could be quite attractive. Here's why it might still not work out. The Trade Desk faces the challenge of fighting against much larger giants in the advertising technology space. It might also take a longer time than anticipated for their new strategies and team to accelerate growth, leading to potential short-term volatility. From a small position, Trade Desk has become one of the smallest in the portfolio. I'm comfortable holding here for now, giving the story enough room to unfold. Remember, these are not recommendations. Each stock has catalysts that could propel its price, but they might not work out in 2026. That said, I remain confident that some will likely turn out well over a 3 to 5 year horizon. Thank you for joining me today. Do share your thoughts with me. Tell me in the comments which stock do you think will do well in 2026. See you in the next video.